Next week it's going to be an absolute thrasher. We've got some major economic statistics coming out. We've got the job openings coming out. We've got unemployment rates in Canada, US, Great Britain. We've got inflation rates coming out. So it's just jam-packed with economic statistics. So make sure you have all your trades ready to go. We'll have a quick look at some of the key ones here. First one is the unemployment rates. So we've seen those, they have been skyrocketing in the US. You can also see that's related to the job openings. So there's fewer jobs available, which means more people that are unemployed can't find jobs. And so the spending of those people go down. And as a result, companies that are dependent on consumer spending will be impacted by. So we can also see the inflation rate has been declining, which with the inflation rate declining and the unemployment rate rising, there is a bigger chance that the Reserve Bank will actually lower the interest rates to ease up on the economic pressure. In volatile times, we're really looking for some diversification. Here we've got a chart that shows us the Nasdaq, which is the candlesticks, and then we have the TLT, which is a 20-year US bond. So we can see this is in the 2020. Basically, you can see the two markets moving together. They're all moving in the same direction, right? So this gives us very little diversification. Here on this side, starting 2023, you can see they start diverging there. And if we draw a line here, you see the stock market's going up and the bond market's going down. And then if we zoom out, and let's look at the current day. So you can see they're still trending on those same trend lines. So here you can see the stock market has declined in the last few months, and our TLT bonds has started trending upwards, which is a really good sign. So we've got some nice diversification happening there. You can see those two there. So hopefully as the trend continues, our TLT bonds will actually counteract the negative impacts of our portfolio. So let's look at what that might look like in a real world scenario. In this particular position, we entered the trade roughly around here, which is the TLT bonds. So this is the 20-year US bonds. And we can see we've made substantial gains there, up to 99.6. So currently it's up 8.11%. And if we look at our triple Q, which is our Nasdaq index, over the same period, we can see roughly from around here, that's actually declined. So in this position, our average entry price was 461, 462, and we're actually down 2.98% on that. So if we look at our holdings overview, we can see total cost basis for TLT is 10,600, and our current market value is 11,450. For triple Q, our cost basis is 843, and that's down to 821. Total unrealized profits is 8% on the TLT and negative 3% on the triple Qs. But the most important thing is you can see here the unrealized profit and loss. So because our position is much bigger in TLT, we've actually made $850 there, and we've only lost $24 on the triple Q. Hopefully that gives you a little bit of insight in how we use diversification to actually outperform the market. So let's change gears a little bit. Yesterday we put a trade into oil, and we can see that has actually declined a little bit further since yesterday. So it's on this massive down trend. Most likely reason for this is the globally deteriorating economic prospects. As people spend less money, they travel less, they use less petrol, in oil, and so the price of oil goes down. The price of oil also has a supply component, and if the price goes too low, supply will dry up, and that will stabilize the price. So what we're looking for here is to reach a bottom. We can see there's a nice bottom that is formed here. This was in the beginning of the year. So it could bounce off this line and continue back up if the economic situation improves, or it can continue down, and our next entry point is down here at 31.86. We'll put in another order for to catch that next wave down. So if we look at the overall price of oil and we zoom out a little bit, we can see at the moment it is roughly about $67 a barrel, compared to the highs is $129 a barrel. So it is actually quite low, but it has gone a lot lower. So we can see around COVID, it actually went to $0 per barrel, which is the first time I've ever seen that. But the low can range through to about $26 a barrel, $30 a barrel. When recessions hit, there's a massive spike down in the price of oil. So whenever the economic situation deteriorates, oil takes a hit. And whenever there's good economic times, oil trends up, as you can see in these examples here. Since COVID, you can see how it's just exploded over the next 2 years as economies were opening back up and the fear started subsiding, and then it's leveled out. And now, as we're heading into an economic downturn, it's starting to trend down as well. So if we go back to our trading instrument, we use the USL ETF that tracks futures for oil spread across 12 months. So the volatility will be slightly less than the actual oil market, but it does follow it relatively closely. You can see as we overlay the oil graph with the ETF oil futures, it follows it fairly closely. So how do we approach this declining market? So we will continue buying. You can see our next buy is at 32 as the market declines. Because oil is a consumable product, the price will recover. If it goes too low, the oil producing companies will curtail supply, and that will push the price back up. It will turn around. It's just a matter of how far down it will go, but we'll keep purchasing and bring our average price down. We have a similar strategy going in our gas position, which is this one here. So if you have a look at where the market is currently, so gas price really spiked up in 2022 and then has sort of declined. So we've started buying down at the bottom here, and it may take months, it may take a few years for that price to spike back up. But once it does, our entry price is $7.78. So then we'll be able to cash out profit once that happens. So in summary, we have 5 key positions. We've got our TLT bonds position. We've got a 12-month natural gas position, our NASDAQ position, our leveraged NASDAQ position, and our US oil position. And the reason for this is threefold. One is diversification between our bonds and our NASDAQ positions. The other is opportunity, which is our natural gas and our US oil. And the third is leverage, which is our TQQQ. So all these trades together will give us the best opportunity to outperform the market in the long term. Join us again next week to discover the important reasons why we use TLT and NASDAQ for our investing.